So good day everyone, I am Miss Kimberly Kudal and I am going to discuss the uses of financial analysis, interpreting financial ratios, basic classifications of financial ratios, and the key financial statements. So first is the uses of financial analysis. So a financial analysis assists in identifying the major strengths and weaknesses of a business enterprise. So it helps the company to determine its strengths and weaknesses. It indicates whether a firm has enough cash to meet obligations, a reasonable accounts receivable collection period, an efficient inventory management policy, sufficient plant, property, and equipment, and an adequate capital structure. So financial analysis also assess a firm's viability or ability to work successfully as an ongoing enterprise and to determine whether a satisfactory return is being earned for the risk taken. So when performing a financial analysis, an analyst may discover specific problem areas in time for remedial action. So for example, ang analyst may detect na ang firm has unused borrowing power that could finance additional income-producing assets. So the results of a financial analysis may indicate facts and trends that can help or assess the financial manager in planning and implementing a course of action consistent with the goal of maximizing shareholder wealth. And also, financial analysis are also used by persons other than financial managers. So for example, sa mga credit managers, in which they may examine basic financial ratios of a prospective customer when deciding whether to extend credit. And then sa mga bankers, in which they use the tools of financial analysis when deciding whether to grant loans. The next topic is interpreting financial ratios. So a financial ratio is a relationship that indicates something about a company's activities. So such as the ratio between sa current assets and current liabilities, or between its accounts receivable and its annual sales. So financial ratios enable an analyst to make a comparison of a company's financial condition over time or in relation to other firms. So ratios essentially standardize various elements of financial data for differences in the size of a series of financial data when making comparisons over time or between firms. So for example, the total profits of IBM or International Business Machines Corporation normally are many times those of Apple Computer because ang IBM is a much larger firm siya kaysa sa Apple. So by computing a ratio such as net profits divided by total assets, the relative performance of the two firms can be assessed more accurately. So successful financial ratio analysis requires that an analyst keep in mind the following points. So first, any discussion of a financial ratios is likely to include only a representative sample of possible ratios. It means in which many other ratios can be developed to provide additional insights. So in some industries, such as the banking industries, analysts use special ratios unique to the activities of the firms in those industries. So next is, financial ratios are only flags indicating potential areas of strength or weakness. One or even several ratios might be misleading, but when combined with other knowledge of a company's management and economic circumstances, ratio analysis can tell much about a corporation. So a thorough analysis requires the examination of other data as well. Next is, an analyst must keep in mind also that a financial ratio frequently must be dissected to discover its true meaning. For example, a low ratio may be caused by either a low numerator or a high denominator. So good financial analysts examine both sa numerator or ang denominator before drawing any conclusions. The next is, a financial ratio is meaningful only when it is compared with some standards such as industry ratio trend, a ratio trend for the specific firm being analyzed, or a stated management objective. So in trend analysis, ratios are compared over time, typically years. So year-to-year comparisons can highlight trends and point out the need for action. And lastly, when financial ratios are used to compare one firm with another, it is important to remember that differences in accounting techniques may result in substantial differences in financial ratios. So failure to consider all of this may lead to incorrect conclusions. Next topic is basic classifications of financial ratios. So companies approach financial analysis from different perspectives. Why? Because different groups inside and outside a company have varying objectives and expectations. For example, mga suppliers and short-term creditors, so they are most likely concerned with a firm's current liquidity and near-term cash generating capacity. While ang mga common stockholders o mga potential investors, mas interested sila sa company's measures of profitability and risk. Because common stock prices are dependent on the amount and stability of a firm's future earnings and dividends. So there are 6 groups of ratios. First is liquidity ratios, in which it indicates a firm's ability to meet short-term financial obligations. The next is asset management ratios, in which it indicate how efficiently a firm is using its assets to generate sales. And then financial leverage management ratios indicate a firm's capacity to meet short and long-term debt obligations. And the next is profitability ratios, in which it measures how effectively a firm's management generate profits on sales, assets, and stockholders' investments. And then market-based ratios, it measures the financial market's evaluation of a company's performance. And lastly, dividend policy ratios indicate the dividend practices of a firm. So each group of ratios will be explained in detail by the next reporter. So proceed ta sa key financial statements. So to illustrate how ratios are used in financial analysis, the financial statements of Drake Manufacturing Company will be examined. So Drake Manufacturing Company is a medium-sized firm that produces various replacement components for the lawn equipment industry. So first is the balance sheet. So the balance sheet is a financial statement that reports a company's assets, liabilities, and owner's equity. So asset is what the company has, liabilities is what the company owes, and owner's equity is what the company owns. So the balance sheet is based on the fundamental equation, assets equals liabilities plus owner's equity. So table 3.1 on your screen contains information on Drake's assets, liabilities, and stockholders' equity. So the figures provide a snapshot view of the firm's financial health on December 31, 2006 and December 31, 2005. So it has a total assets of $81,890 pagka 2006 and $77,026 pagka 2005. So same po sa iyang total liabilities and stockholders' equity. The next is income statement. So an income statement shows a company's financial performance during a particular period. So it details a company's revenue, gains, expenses, losses, and net income. So revenue, money a company actually receives during a specific period. Gains is an increase in the value of an asset or property. Expenses, the economic cost a business incurs in order to earn revenue. And then losses, the portion of an insurance company's reserves set aside for unpaid losses and cost of investigation and adjustment for losses. So income statement is based on the fundamental equation, profit or income equals revenues minus expenses. So the income statement in table 3.2 on your screen indicates Drake's performance during the year ended December 31, 2006. So the cost of sales, other operating expenses, interest expenses, and taxes are deducted from the revenues generated or net sales to arrive at the firm's net income or earnings after taxes. with a total of $5,016. So the statement in Table 3.2 also shows how the firm's earnings are distributed between dividend payments to stockholders and earnings reinvested in the firm. Next is a common size financial statement. So a common size financial statement displays entries as a percentage of a common base figure rather than as absolute figure. So there are two types of common size financial statements: the common size balance sheet and the common size income statement. So a common size balance sheet shows the firm's assets and liabilities and stockholders' equity as a percentage of total assets rather than in dollar amounts. So table 3.3 shows the Drake Company's common size balance sheet on December 31, 2006 o pagka December 31, 2005. While ang common size income statement lists the firm's income and expense items as a percentage of net sales rather than in dollar amounts. So table 3.4 contains Drake's common size income statement for the year ended December 31, 2006. So common size financial statements allow trends in financial performance to be detected and monitored more easily than with financial statements showing only dollar amounts. And lastly, statement of cash flows. So statement of cash flows is a report that gives the movement of cash during the period under consideration. So it has, there are three classifications of statement of cash flows. You have the operating activities, investing activities, and financing activities. So operating activities refers to the main activities of a business of purchase or sale of goods, providing of services, etc. For example is a sale or purchase of goods, and then depreciation. The next is investing activities. So investing activities shows the investment a business does in either a property, security, or particular asset, or etc. For example, purchase or sale of a building or purchase of an investment. And financing activities, when a business needs a finance, it looks for various sources like raising funds through shares or debts, etc. Example, issuance of equity or preference shares, and then payment of dividends. So the statement of cash flows is useful in financial analysis also because it indicates how a firm generated cash flows from its operations, how it used cash in investing activities, and how it obtained cash from financing activities. So I think that's all of my discussion. So thank you.
Hello everyone, my name is Gideon Peter Cavejo and I will discuss the first three basic classifications of financial ratios. First, we have liquidity ratios, which include current ratio and quick ratio. Next, we have asset management ratios, which include average collection period, inventory turnover ratio, fixed asset turnover ratio, and total asset turnover ratio. And third, we have financial leverage management ratios, which include debt ratio, debt to equity ratio, times interest earned ratio, and fixed charge coverage ratio. Liquidity ratios are quick measures of a firm's ability to provide sufficient cash to conduct business over the next few months. So liquidity ratios are measurements that determine the company's ability to pay its short-term obligations. This ratio also show how fast the company can convert its current assets into cash so that it can pay its short-term obligations on a regular basis. Examples of liquidity ratios we have: first, current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. So diri na to may bawaan kung kayang makover sa company's current assets ang iyang current liabilities. The formula is current ratio equals current assets over current liabilities. For example, Drake Company, its current ratio is 1.97 or 2:1. However, the industry average is 2.40 times, which is higher compared sa current ratio ni Drake nga 1.97. So there is a risk on the part of Drake Company in terms of its current ratio. The next is quick ratio. It's an indicator of a company's short-term liquidity position and measures a company's ability to meet its short-term obligations with its most liquid assets. It is similar sa current ratio, and the only difference is that the inventories are subtracted from the current assets because this ratio recognize that uh, inventories, especially work in process inventories, are often one of its least liquid assets. Quick ratio is sometimes called acid test. So its formula is quick ratio equals current assets minus inventories over current liabilities. For example, in Drake Company, its quick ratio is 0.89 times and industry average is 0.92 times. We can say that uh, both ratios are almost equal, and so there is a low risk on the part of Drake Company in terms of its quick ratio. Next, asset management ratios indicate how much a firm has invested in a particular type of asset or group of assets relative to the revenue the asset is producing. The asset management ratios uh, determine the how effective and efficient the company is in utilizing its assets to generate sales or revenues. Examples of asset management ratios. First, we have as average collection period. It refers to the amount of time it takes for a business to receive payments owed by its clients in terms of accounts receivable. In other words, the average collection period is the average number of days an accounts receivable remains outstanding. The formula is average collection period equals accounts receivable over annual credit sales divided by 365. For example, in Drake Company, its average collection period is 59.3 days and industry average is 47 days. Which means nga the clients of Drake Company take longer to pay its uh, obligation compared sa industry average na 47 days. Next is inventory turnover ratio. It is a financial ratio showing how many times a company has sold and replaced inventory during a given period. So the inventory turnover ratio shows how fast the company sells and replaces its inventory. The formula is inventory turnover equals cost of sales over average inventory. So, for example, in the company, its inventory turnover is 3.16 times, which is lower compared to industry average nga 3.9 times. And we can say, uh, by comparing the two ratios, that there is a risk on the part of the company in terms of its inventory turnover. Then next example of asset management ratio is the fixed asset turnover ratio. It is an efficiency ratio that measures how well a company uses its fixed assets to generate sales. So this ratio reveals how efficient a company is at generating revenue while using its fixed assets. The formula is fixed asset turnover equals sales over net fixed assets. So fixed assets mo ni ang mga long-term assets like property, plant, and equipment, PPE. And then, for example, In Drake Company, its fixed asset turnover is 3.56 times. If we compare it to industry average ng 4.6 times, you can say that it is lowered. So there is a risk on the part of Drake Company. And next is the total asset turnover ratio. It is a ratio that compares the sales of a company to its asset base. So it is similar sa fixed asset turnover ratio. The only difference is that there is a total asset turnover ratio from the word itself, total asset. The total asset is used. For example, in J Company, its total asset turnover is 1.38 times. And industry average is 1.82 times. Which means nga lower ang total asset turnover ni Drake compared sa industry average. Which means nga there is a risk. Then, finally, we have the financial leverage management ratios. These ratios measure the degree to which a company is employing financial leverage and as such are of interest to creditors and owners alike. So financial leverage management ratios compare the company the company's total debt obligation to either the assets or equity of the business. So if you are unfamiliar with financial leverage, excuse me, it is the use of borrowed funds to finance the purchase of assets. So the financial leverage management ratios also shows how much of the company assets belong to the shareholders rather than to the creditors. If when the shareholders own a majority of the company assets, the company is said to be less leveraged, which is good. However, when the uh, creditors own a majority of the company assets, the company is said to be highly leveraged, which is not desirable. Example of financial leverage management ratios, we have first a debt ratio. It measures the proportion of a firm's total assets that is financed with creditors' funds. In other words, it shows how many assets the company must sell in order to pay off its liabilities. Its formula is debt ratio equals total debt over total assets. For example, in Drake Company, its debt ratio is 0.58 or 58%, which is higher compared to industry average that is 47%. So we can say that there is a risk on J Company in terms of its debt ratio. Then debt to equity ratio. It shows the proportions of equity and debt a company is using to finance its assets. So this ratio measures how much debt the business is carrying as compared to the amount invested by its owners. It also indicates how much debt and equity a business uses to finance its operations. For example, in Drake Company, its debt to equity ratio is 1.383 or 138.3%, which is higher compared sa industry average na 88.7%. So we can say that there is a risk on the J company in terms of its debt to equity ratio. Next is we have the times interest earned ratio. It is a measure of a company's ability to meet its debt obligations based on its current income. So, dili na to mabawaan kung kaya bang mabayaran sa company ang ijang interest payments gamit ang ijang current income. Formula is times interest earned equals earnings before interest and taxes over interest charges. For example, in your company, its times interest earned is 3.65 times and the industry average is 6.7 times. If we look at both of the ratios, you can say that the ratio of a J company is way lower compared sa industry average ng 6.7 times. There is a risk on the part of J company in terms of times interest earned ratio. And last is we have fixed charge coverage ratio. It measures a firm's ability to cover its fixed charges such as debt payments, interest expense, and equipment lease expense. So this ratio measures a firm's ability to pay all of its fixed charges or expenses with its income before interest and income taxes. Its formula is we have fixed charge coverage equals earnings before interest and taxes plus lease payments over interest plus lease payments plus preferred dividends before tax plus before tax sinking fund. So the fixed charge coverage for Grey Company is 1.76 times, and the industry average is 4.5 times. Uh, we can say that its ratio is uh, lower, way lower compared sa industry average nga 4.5 times. So there is a risk on the part of J Company in terms of its fixed charge coverage ratio. And that ends my uh, presentation. Thank you for listening.
So hello everyone, this is Arlene Cortina. So Mr. Gideon already discussed to you the first three classification of basic financial ratios, which leaves me to discuss the other three financial ratios, which are the profitability ratio, market-based ratio, and dividend policy ratios. So the profitability ratio measures how effectively a firm's management generate profits on sales, assets, and stockholders' investment. There are several types of profitability ratios: the gross profit margin ratio, the net profit margin, the return on investment ratio, and the return on stockholders' investment. The first one is the gross profit margin ratio, which measures the relative profitability of a firm's sale after the cost of sales have been deducted. Thus, it reveals how effectively the firm's management is making decisions regarding pricing and control of production costs. The second profitability ratio is the net profit margin, which measures how profitable a company's sale is after all expenses have been deducted. This includes taxes and interest. The third one is the return on investment ratio that measures a firm's net income in relation to the total asset investment. And lastly, the return on stockholders' equity ratio that measures the rate of return that the firm earns as stockholders' equity. So the fifth classification is the market-based ratios, which measures the financial market's evaluation of a company's performance. The first one is the price to earnings ratio, which relates a company's share price to its earnings per share. And on the other hand, the market price to book value ratio, which is calculated by dividing the price of a share of stock by the book value per share. So the last classification of financial ratios is the dividend policy ratios, which can be two things: the payout ratio and the dividend yield. When we say payout ratio, this indicates the percentage of a firm's earnings that are paid out as dividends. And then the other one is the dividend yield, which is the expected yearly dividend divided by the current stock price. So those are the six classification of financial ratios. Now let's have Mr. Giovanni to discuss the trend analysis. That would be all. Thank you.
Hi everyone, my name is Giovanni B. Costillas and I am going to present the trend analysis. So when we see trend analysis, first is trend is the overall direction of a market or an asset price. So through trend, makita na to sa isa ka business kung asa padong, kung asa siya na direction padong. Di ba? Di ba guys, as a individual, puhon-puhon, gumawa ng tagtrabaho, di ba? Um, mangita man tag or mahuman tag eskwela, mangita man tag trabaho. Ug sa atong panarbaho, I believe na di mo budget mas gamay ra ang improvement sa atong kinabuhi ng murag kita um, kanang tawagan ning dali ra maasin. So I believe nga kanang masinso nga itong kinabuhi through having a business. So, kaniyang topic guys is related din siya sa business. Kay puon magnegosyo ta or sa kanang mga negosyo ron, trend analysis is part of the business. So, unsa din buhat dun sa trend analysis no? Sa isa ka business susod sa kanegosyo. So mao na to nga um, trend is a direction or business. May buuan kung asa padong ang edang negosyo in a right direction ba or in a wrong direction. Also, in trend analysis, it shows that there is a higher swing highs and higher swing lows for uptrend and lower swing lows and lower swing highs for a downtrend. So through trend analysis, um, makahibaw ta sa atong negosyo kung kano sa ang uptrend and downtrend. For example, sa imong negosyo ng kahuman ka o 1 year and within that year through uses historical data makaibaw ta nga anang nga buwan na taas ang imong halin, meaning daghan na malit or halinon ang imong products and then nakaibaw po ta through trend analysis nga anang nga seasons or anang nga time min downtrend ang imong negosyo, meaning min ubos or di ka dyan halinon imong products. And also, trend analysis is to gain insight into the direction the company is moving, indicates that a firm's performance. It also reveals when improving or deteriorating. It also attempts to predict future stock price movements, and it also based on recently observed trend data, uses historical data such as price movements and trade volumes to forecast the long-term direction of market sentiment. So, through trend analysis, magamit po nato siya to forecast or to predict future sa atong negosyo. No, kay, di ba, nagamit nato sa historical data like sa katong within a year sa inyong pagnegosyo makahibaw ba nganong uptrend nganong halinon na siya nga anang buwan na or nganong kanang nga time is kanang wa kita ang negosyo no. Magamit na sa as a business owner or um, manager sa isa ka negosyo no nga ma-apply na nga idea no nga na sila yung mga preparation o mga strategy nga ma-address ko mahitabo nga maka-downtrend na sila mga alternative ways no alternative strategies para ma-address para di sila maka face na pud og kanang murag malugi something like kanang di sila makabawi sa ilang kapital. So mo trend analysis. sa paggamit sa atong or sa resources when in terms of asset liabilities equities sa isa ka negosyo may bawaan ako kung in a right direction ba sa di ba sa negosyo sa mga dago-dago ang negosyo no um, kanang maka nanay idea ng sa mga asset liabilities and owner's equity part siya mo sa isa ka business and through kanang paggamit ana in a good way no dako posibilidad na it leads to a right direction nindot ang resulta. So moving forward is the analysis of profit profitability return on investment. Sa paggamit nato sa mga assets, liabilities, and owner's equity, and also the capital or the owner's equity no capital mo mga na itong kanang first nga buhaton nga makatukod tag business mo kuan man tag capital or something mo loan ta para natay ika kuan sa ka negosyo. So through through by using that resources as a business owner or as ikaw nga nagkuan sa isa ka business di jud ka magpataka og um, negosyo-negosyo kung nakahibaw ka nga way moabot nimo way mabalik nimo kung lugi ka syempre imong siguraduhon nga naay mabalik nimo so dili musod ang return on investment. So it helps us perform and predict where current business operations and practices will take us. It will give us ideas how we might change things to move our business in the right direction. So through return on investment, maka-determine ta kung unsa to nga time nga gamay ang gamay ra nga kita ang imong negosyo. Unsa ba to nga time nga dako kita ba? Ma-apply kay ba dito? Ma-apply kay ba dito nga information or data para in the next future is nindot na pud ang dagan no? Para dako kita syempre kay sa isa ka business profit man jud ang kuan ana purpose para maka magkaroon ng kita. So return on investment it is can be examined more closely to provide additional insight into its significance. Net profit margin times the total asset turnover to get the ROI. So examine a firm's ROI in terms of margin and turnover. As Arlen said earlier, nga na-mention niya ang margin. So deficiency in either one will lower a firm's return on investment. So what is margin? Margin it can refer to the difference between the cost of a product and how much you sell it for. It can also mean the amount by which revenue from total sales exceeds cost in a business. Turnover is the total amount of money your business. So in short, kaning margin and turnover is magdepende pud ni siya kung nindot ang dagan sa imong negosyo. Kay kung may ang margin in a percentage form naman siya sa more profit no kung nindot ang kung taas kag kita tako kag margin positive margin also dako kag turnover. A good margin will vary considerably by layers and size business what is general term 10% in profit. Whenever the higher the asset turnover ratio the more efficient so malagi to kung dako ang turnover dako ang bali ang nahalin sa ka business so makaingon ang efficient ang business nindot ang pagdagan sa business nindot ang strategy nga ilang gi-apply. So during the announced profit margin is net income divided by sales. Sama na pagkuha sa profit margin, measuring the percent of each dollar in sales. The three types of profit margin, gross operating and net. So na-discuss na ni Arlene Cortina. So asset turnover is sales divided by total assets. Measures how much each dollar in asset generated in sales. So money ang formula sa asset turnover. Total sales divided by the beginning assets plus ending assets. So analyzing profitability to return on stockholders' equity. So as nakita ninyo nga return on stockholders' equity. So meaning corporation nature o environment niya siya kailangan sa stockholders. So same na ganiha sa return on investment nga di magpataka-taka o kanang um, kung ano products kung di halinon. Kung kahibaw kung na mabalik mo syempre kwarta di lalim mo ngita kwarta di magpataka kag kanang kuan kanang support or tuog unsa imong kuan nga products nga baligya pag antod di halinon syempre ma-waste na siya no. Same na sa ROI ganiha. Ang ROI naman is ma-apply siya sa tanang business when return on stockholders equity is kanang corporation na siya nga nature. So sources of comparative financial data. So kani sila Dun and Bradstreet Risk Management Association, Moody's annual report. So mao ni sila ang mga record keeping sa mga business kasi klaseng industry. So diri pud mahibaw-an nato ang mga negosyante diri pud mutan-aw kung asa na padung ilang mga competitors. Like for example, same sila industry. Then ang ilang industry is mingkuan na kana bang di nahalinon. So ang katong mga competitors nila mamali na jud kay syempre di naman kamo stay sa isa ka industry kung di na siya halin dito to kas lain industry nga mas daghan mas halinon siya. So ikaw as a negosyante no as or a business owners or kanang gusto kang makahibaw nga unsa nga industry ang halin nito pwede ra po diri ka diri matan-aw makit-an mga sources of comparative financial data. Makita nimo nga mga competitors ng bali ng industry kay mo na yung lisod kusog di ay ang halin nito ana mo na nga ang uban pod mangalin pod pinagi diri. So that would be all guys. Thank you and God bless us all. So the next reporter is Mr. James Benson Intuna. Thank you.
Thank you, Mr. Giovanni. And now let's move on to a word of caution about financial ratio analysis. Throughout the analysis of great manufacturing company, we emphasize that the analyst must exercise caution when evaluating a firm's financial ratios. Although ratios can provide valuable information, they can be also misleading for a number of reasons. So, first, ratios are only as reliable as the accounting data on which they are based. So, most U.S. companies' financial statements are prepared in the GAAP or the Generally Accepted Accounting Principle. Even though careful financial analysis provide excellent insights into the direction and relative strength of the firm, the financial analyst must keep in mind that the GAAP gives firms considerable latitude in reporting their financial positions. Then second, with the exemption of disclosing upper and lower quartiles values, firms often do not report information about dispersion or distribution of individual values on the main ratio. If the reported ratios are dispersed widely, the industry average will be questionable value because it may not reflect in the so-called typical firm in the industry. Then the third is valid comparative analysis depends on the availability of data for approximately defined industries. Some industry classifications are either too broad or too narrow in evaluating a particular firm. Most firms operate in more than one industry which make analysis more difficult. So, kaluma-luma, na lang daghan na mo nang maglisod. Then the fourth one is it is important to remember that financial ratios provide a historic record of the performance and financial condition of the firm. Further analysis is required before this historic record can be used as a basis for future projections. Then the fifth one, or the final, comparisons of a firm ratios with industry norms may not always be what they seem. On the other hand, even if a firm's ratios compare favorable with those of better performing firms in the industry, it does not necessarily mean that the firm is performing adequately. Ratios should not be viewed as substitutes for sound business judgment. Instead, ratios are just simply tools that can help management to make better decisions. And now let's move on to the earnings and balance sheet quality and financial analysis. When performing a financial analysis of a firm, an analyst must be mindful of the quality of the earnings reported by a firm, as well as the quality of the firm's balance sheet. These two dimensions of financial analysis can have a critical impact on the final assessment of the firm's financial condition. Earnings quality. When considering the quality of the firm's earnings, two key factors should be kept in mind. First is high quality earnings tend to be cash earnings. The promotion of a firm's earnings that can be viewed as cash earnings is greatly influenced by the firm's procedures with respect to sales revenue recognition. For example, a firm may recognize a sale at the time a contract is signed, a down payment is made, or when the full proceeds from the sale are actually collected as cash. Generally, the closer the recognition of a sale is to the time the full proceeds from the sale are collected, the higher is the quality of the firm's reported earnings. In business downturns, earnings often drop while cash balances soars or rise. Another area of earnings reporting abuse is so-called pro forma or the profitability measures. They are computed by companies as if certain ordinary expense did not exist. In particularly abusive example, waste management treated the cost of painting its trucks as an extraordinary one-time expense and thus excluded the expense from pro forma earnings calculation. A firm's earning can be viewed as high-quality earnings as greater proportion of those earnings derived from the regular recurring transactions. To the extent that reported earnings reflect the impact of non-recurring transactions, the quality of those earnings is reduced. The balance sheet quality. The quality of a firm's balance sheet should be also a concern to a financial analyst. If the assets on the firm's balance sheet have a market value equal to or greater than the book value on which they are being carried, this enhances the quality of the firm's balance sheet. In contrast, if a significant portion of the assets of a firm has a market value substantially below book value, the quality of the firm's balance sheet is reduced. So, many firms is so-called smokestacks industries record losses as a significant portions of their assets are abandoned and written off as losses. So, ang firm ani nga nag-practice as the Kaiser Aluminum, US Steel, Bethlehem Steel. So, Bethlehem Steel declared bankruptcy in late 2001 as it found its remaining assets could no longer generate adequate levels of profits and cash flows. So, katinggo po sila. In addition to asset quality issues, an analyst should always be aware of the hidden liabilities. Then, ethical issues. The Sarbanes-Oxley Act and the financial reporting process is the primary values of good corporate governance and financial reporting should include transparency, accountability, and integrity. So, morning ang upat. Transparency. Companies should be willing to provide information needed by their various stakeholders to make informed decisions. So, information is transparent when it provides the user with a clear understanding of the results of the company's operation. So, namely, its income and cash flows, assets and liabilities, and other aspects of the business. Then, the accountability. There must be a strong commitment to a culture of accountability among of all participants, so including the board of directors, officers of the corporation, and its external auditors. So, wherein the individual must take responsibility for their carrying out his or her role in the financial reporting process. Then integrity. Transparency and accountability depends on individuals trying to do the right thing, doing what is expended or even permissible is not accepted. So integrity is the foundation for the various stakeholders being able to trust the information generated by the companies. Then, the Sarbanes-Oxley law contains various provisions that seek to restore the public's faith in the financial reports issued by companies. So, napoy tulo dire. Ang audit committee. The committee of the board of directors must consist of independent directors. So, at least one member of the audit committee must meet specified criteria as a financial expert, and if not, the reason of the absence of such a member must be specified. Then company executives, the CEO of the CFO must affirm the completeness and accuracy of the company's quarterly and annual reports. So, certifying a report does not conform to the law subjects that officer to a fine up of $1 million and a jail sentence up to 10 years. External auditors. The external auditors is prohibited from providing any major non-audit services to the company, such as bookkeeping while performing the audit. Then, therefore, the Sarbanes-Oxley Act established the Public Company Accounting Oversight Board under the direction of the SEC to monitor compliance with the law. The market value added, an alternative measure of performance. So, as already discussed, traditional financial analysis focuses on a set of financial ratios derived primarily from accounting information. Using an approach such as DuPont analysis, a firm's financial performance can be dissected into its component elements. The ultimate measure of the firm's performance is the return on common equity. Although insights can be gained from this type of analysis, traditional financial analysis suffers from weaknesses inherent in the reported accounting information, and it does not directly consider this in the measure of the performance. The greatest shortcoming of traditional financial analysis is the lack of a direct tie between performance as measured using financial ratios and shareholder wealth as measured by the market of the price of the firm's stock. Now, let's move on to the market value added concept. MVA is defined as the market value of debt, preferred equity, and common equity capitalization less capital. Capital is a measure of all cash raised from investors or retained from earnings to fund new investment in the business since the company's inception. The formula is MVA equals market value less capital or minus capital. MVA is the capital market's assessment of the accumulated net present value or the NPV of all the firm's past and projected investment projects. Then, economic value added. Economic value added is a measure of operating performance that indicates how successful a firm has been at increasing the MVA of the enterprise in any given year. So, EVA defined as return on capital or the R, the cost of capital, or K, less na siya sa cost of capital, where R is the net operating profits after tax divided by beginning of the year capital, and K is the weighted after tax cost of the capital. Implications of MVA and FVA. So, growth in earnings does not necessarily add to the value of an enterprise or MVA unless it is achieved by making investments such that they earn as a return in excess of the cost of capital or the positive EVA. Then, inflation and financial statement analysis. Inflation can cause a number of problems for a financial analyst who is trying to assess the performance of the firms over time and in comparison with other firms in the industry. So, in particular, inventory profits, short-lived increased profits that occur as a result of timing of price increases can make a significant difference in a firm's reported earnings from a year to a year. Most companies do not want to pay income taxes on inventory profits. Why? Preferring to use these funds to replenish inventories, especially in inflammatory times. Fortunately, there is a way of avoiding or deferring the necessity of reporting their higher profits. Then the last in, first out, or the LIFO, familiar man tanay. Inventory valuation method assumes that the items of a firm's uses from inventory are those that were acquired most recently. Thus, they can be priced out of the inventory based on the most recent inventory acquisition cost. In contrast, the FIFO, or the first in, first out method of inventory valuation, which assumes that the items a firm uses from inventory are the oldest items in the inventory, results in the firms having to show a higher profit and therefore pay higher income taxes. The accounting method used for the inventory will affect a firm's profits and its balance sheet. Hence, any financial ratios that contains balance sheet inventory figures or net income will vary from one firm to another, depending on a firm's accounting treatment of the inventory. Then, inventory profits and inflation are only two factors that can be affect a firm's reported earnings. Differences in the reported of earnings, the recognition of sales, and the other factors can be make comparisons between the firms somewhat misleading. Again, a good financial analyst will always go behind the figure states on a firm's income statements or the balance sheet to find out what is actually occurring in a company. Then, thank you for listening.